Welcome back to the Deep Dive. Today, we are really getting into something fundamental in personal finance.
Yeah, something that trips up a lot of people, actually.
Exactly. It's one of those things that sounds simple, but then you dig in and wow, it gets confusing fast. We're talking about funds.
Right. Specifically, index funds, mutual funds, ETFs, and those, let's call them mysterious hedge funds.
That's the lineup. You hear these terms thrown around all the time, right? Especially online, finance creators saying,
Just put your money in an index fund. Yeah, we hear that constantly.
but what are these things? How are they actually different? And maybe the most important question for you listening in 2025, which ones should you even be paying attention to?
That's the mission for today. Cut through all that jargon, all the acronyms, and give you a really clear picture. Think of it as an operational guide.
Okay, let's do it. And maybe start right at the beginning, because the word fund itself can sound a bit intimidating, abstract.
It can, yeah.
Yeah.
But the concept, super simple. At its heart, a fund is just a pooled budget.
Pooled budget. Okay.
Think of it like a shared basket. Instead of you having to go out and buy, say, one share of Apple, one bond from the government, maybe look into some real estate, which is a ton of work, right?
Uh-huh. A lot of work. And requires a lot of capital for some of those.
Exactly. So instead, you pool your money with lots of other investors. The fund uses that big collective pot of money to buy a whole bunch of different investments, stocks, bonds, whatever its strategy is.
Okay, so it's like chipping in together. I like the birthday party analogy we talked about earlier.
Oh, yeah, that's perfect. Imagine planning a big party. If one person had to pay for everything, the food, the drinks, the cake, maybe renting a place.
It'd be incredibly stressful
Yeah,
and expensive for that one person.
totally overwhelming. But if everyone coming chips in, say, $20,
Suddenly it's manageable. The group budget covers everything easily.
that's exactly how a fund works. Everyone puts in their money, creating this large pool. And that pool allows the fund manager to buy a wide variety, a diversified set of assets.
So instant diversification, you're not putting all your eggs in one basket.
Yeah.
And crucially, someone else is handling the actual buying and selling, managing the whole thing.
Precisely. You buy shares of the fund, representing your piece of that collective basket, and you share in the performance of all those underlying investments. It takes away a lot of the individual stress and research burden.
Got it. That core idea, pooling money for collective investment, that's the foundation for all four types we're looking at today.
That's the bedrock, yes. But how they manage the money, what they invest in, how much they cost, and even how you buy and sell them, that's where they diverge dramatically.
Okay, so let's lay out the roadmap then. Four main types on the docket.
Yep. We'll start with index funds, the passive ones, then mutual funds, the active ones. We'll dive into the high roller world of hedge funds and finish with exchange-traded funds, ETFs, which are kind of a hybrid.
And for each one, we need to hit the key points. How's it managed? What are the fees really like? What's the risk level? And critically, how does the pricing work? That last one is surprisingly important.
Absolutely. It gets into things like NAV and real-time trading, which makes a big difference in how you experience the investment.
Okay, let's kick off with index funds. Like you said, these are the ones that everyone seems to recommend, especially for beginners. Just buy an index fund and chill. Why? What's the magic here?
The magic, if you can call it that, is passive management. It's a fundamentally different philosophy. Index funds don't try to be clever. They don't have a manager picking stocks they think will go up.
No superstar stock pickers involved.
Nope, none. Instead, they simply aim to copy or track a pre-existing list of investments. That list is called an index.
Okay, so what is an index then? You hear names like the S&P 500 all the time.
An index is basically just a list. Think of it like a scoreboard or a representative sample for a specific part of the market. It's a theoretical measurement, not something you can directly invest in itself.
Like a benchmark.
It's exactly a benchmark.
So the S&P 500 index, for example, represents the performance of 500 of the largest, most established companies in the U.S. The index itself is just a calculation, a number that goes up or down.
And the index fund based on it.
The index fund's job is just to replicate that list perfectly, or as perfectly as possible. It buys shares in all 500 of those companies, trying to hold them in the same proportions as they exist in the index. It's investing by following a recipe, essentially, an algorithm.
Got it. So no human judgment calls on whether Apple is a good buy today.
None. If Apple is a big part of the S&P 500 index, the S&P 500 index fund must hold a lot of Apple. If a company gets dropped from the index, the fund sells it. Simple as that.
Let's make this concrete. You mentioned the S&P 500. What are the
Mhm.
other big ones people should know?
Well, the S&P 500 is definitely the most famous. It's seen as a proxy for the overall U.S. stock market because it's so broad and covers those big established players. One key thing, though.
It's cap-weighted, capitalization-weighted, which means the bigger the company's total market value, the more influence it has on the index's performance.
Ah, okay. So giants like Apple, Microsoft, Amazon, their ups and downs move the needle way more than smaller companies in the 500.
Precisely. If those top few have a bad day, the whole index can dip. Even if most other companies are doing okay, it's important to understand that weighting.
Makes sense. What else?
Then you've got the NASDAQ composite. This one is heavily weighted towards technology companies. Think Apple, Microsoft, Amazon, Google, Facebook, Meta now.
So more tech-focused, probably more growth-oriented, maybe a bit more volatile than the S&P 500?
Generally, yes. Over the last decade or so, with a huge run-up in tech stocks, NASDAQ index funds have often seen really strong growth, but yeah, sometimes with bigger swings.
Okay, and the third big one.
That's usually the Dow Jones Industrial Average, often just called the Dow. This one's different. It only tracks 30 large, well-known U.S. companies.
Only 30. That sounds tiny compared to 500.
It is, and it's price-weighted, not cap-weighted, which is a different calculation method. It includes companies from various industries, think names like Coca-Cola, Boeing, Johnson & Johnson, Home Depot. It's seen as representing the sort of blue-chip industrial side of the economy.
So S&P 500 for broad U.S. market, NASDAQ for tech growth, Dow for established industrials. And I assume there are indices for like international stocks or small companies too.
Oh, absolutely. There are indices for everything imaginable. Small cap U.S. stocks, international developed markets, emerging markets, specific sectors like energy or healthcare, bond indices. You can find an index fund to track almost any slice of the market you want exposure to.
Okay, so the core idea is passive replication of a list. How does that connect to the biggest selling point, the fees?
It connects directly because there's no need for that expensive team of analysts, researchers, and star managers making active
The
decisions.
costs are way lower.
Dramatically lower. The main fee you pay for an index fund is called the expense ratio, and for index funds, these are typically super low.
How low are we talking?
You can often find major index funds, like those tracking the S&P 500, with expense ratios around 0.02% to maybe 0.20% per year.
Okay, 0.02%. Let's put that in perspective. If I invest $1,000, what does that actually cost me per year?
At 0.02%, that's 20 cents a year.
20 cents
No.
on $1,000.
Yep. Even at the higher end, say 0.20%, it's only $2 per year on that $1,000. It's incredibly cheap compared to other investment types. Vanguard, BlackRock size shares, Fidelity, the big players offer these very low-cost options.
And that tiny fee difference compounded over decades.
Yeah.
That's where it really matters, right?
That's the silent killer, or the silent wealth builder, depending on which side you're on. Let's run a quick example. Say you invest $100,000, and let's assume, hypothetically, it grows at 7% per year for 30 years.
Okay.
With an index fund charging just 0.1% per year, that $100 K could grow to roughly $745,000.
Wow, okay.
Now imagine another fund, maybe an actively managed one we'll discuss next, that charges 1.0% per year. That seems like a small difference, right? Just 0.9% more.
Yeah, less than 1%.
After 30 years, at that same 7% growth before fees, the 1.0% fee would leave you with only about $647,000.
Hold on. That's nearly a $100,000 difference, just from that 0.9% fee difference over 30 years.
Exactly. Almost 100 grand less in your pocket, purely because of higher fees eating away at your returns year after year. Compounding works both ways on returns and on costs.
It's staggering, actually. It really highlights why people like Warren Buffett are always recommending low-cost index funds for most people. Low cost, low effort, broad diversification.
And historically pretty solid long-term performance just by tracking the market average. You get market returns minus that tiny fee. It's a very reliable strategy for building wealth over time without needing to be an expert yourself. The risk is also generally lower because you're spread across hundreds, sometimes thousands of companies. If one goes bankrupt, it barely affects the overall fund.
Okay, that makes a ton of sense. But there's one more crucial detail about traditional index funds we need to cover, how they're priced and traded. It's not like buying a stock, right? Tell us about the NAV.
Right. This is key. Most traditional index funds are structured as open-ended funds. And what that means for you, the investor, is that they only calculate their price once per day.
Once. When?
After the stock market closes, typically around 4 p.m. Eastern Time in the U.S., this end-of-day price is called the net asset value, or NAV.
Okay. How do they figure out that NAV?
It's pretty straightforward math, actually. They take the total closing market value of all the assets the fund holds, all the stocks, bonds, cash, everything. They subtract the fund's daily operating expenses, that tiny slice for the expense ratio. Then they divide that final number by the total number of shares the fund has issued to all its investors.
So total assets minus expenses divided by shares outstanding, that gives you the price per share for that day.
Exactly. That's the NAV.
What does that mean practically? If I decide I want to buy $5,000 worth of an S&P 500 index fund at, say, 11:00 in the morning, I don't actually know the exact price I'll pay.
That's precisely it. You place your order during the trading day. Maybe a market looks good at 11 a.m., but your order won't actually execute at 11 a.m.'s price. It queues up.
And waits until.
It waits until the market closes at 4 p.m. and they calculate that final NAV for the day. If you got your order in before the cutoff time, usually 4 p.m. ET, you will buy shares at that day's closing NAV.
So I could place my order when the market seems up, but if it tanks between then and the close, I get the lower closing price, or vice versa.
Correct. You get the price determined after the bell rings, regardless of what the market was doing when you clicked buy or sell. If you place your order after the 4 p.m. cutoff, you get the next day's closing NAV.
That feels a bit disconnected. Why structure it that way? Why not price it second by second like a regular stock?
It's mainly designed to prevent a type of trading called arbitrage. Because the fund holds hundreds of stocks, there could be tiny brief discrepancies between the fund's last calculated price and the real-time value of all its underlying holdings. Sophisticated traders could try to exploit those tiny gaps. By only pricing it once a day, based on the official closing prices of all the underlying assets, they ensure everyone who buys or sells that day gets the exact same fair price based on the finalized market values. It maintains stability and fairness for long-term investors. But the trade-off is...
You lose that real-time price control. You can't react instantly to market moves during the day.
Exactly. That lack of intraday pricing is a defining feature of traditional open-ended index funds. And mutual funds, too, as we'll see.
Got it. One last technical point on index funds. How do we know if a fund is actually doing a good job of, well, tracking its index? Is there a way to measure that?
Yes, there is. It's called tracking error. Because funds have those small fees, and sometimes they hold a tiny bit of cash for operational reasons, or maybe they can't perfectly replicate the index due to the sheer number of holdings. Their return won't exactly match the index's return.
Makes sense. There's always some friction.
Right. Tracking error measures that difference, that slippage between the fund's performance and the benchmark index's performance. For a good, well-run, low-cost index fund, you want that tracking error to be absolutely minimal, as close to zero as possible. It shows the fund is efficiently doing its one job, mirroring the index.
Okay, that deep dive into passive index funds sets us up perfectly for the next category, mutual funds. Because here, the philosophy completely flips, right? We're moving from passive to active management.
Exactly. The structure is similar in one way. Mutual funds also pool investor money to buy a diversified portfolio of assets. That core fund concept is the same.
But the goal is totally different.
Totally different. Mutual funds are run by professional managers or teams of managers and analysts whose explicit job is to actively manage the portfolio to try and beat the market or beat a specific benchmark like the S&P 500.
So, unlike the index fund just copying the list, these managers are making deliberate choices, buying specific stocks they think are undervalued, selling ones they think are peaking, maybe shifting money between sectors based on economic forecasts.
Precisely. They're doing research, analyzing companies, making macroeconomic calls. They believe their skill and strategy can generate returns above what you'd get just by passively tracking an index. It's a high-effort, research-intensive approach.
And all that effort, that expertise or claimed expertise, comes at a cost. We already touched on this, but let's revisit the fees for active mutual funds.
Yeah, this is the crucial trade-off. Because you're paying for that active management team, the research, the trading, the expense ratios for mutual funds are significantly higher than for index funds.
How much higher, typically?
We're often looking at ranges from, say, 0.5% to 1.5% per year. Sometimes even higher, maybe closer to 2% for certain specialized funds.
Okay, let's pause there. We saw that even a 0.9% fee difference could cost nearly $100,000 over 30 years. If an index fund costs 0.1% and a mutual fund costs, say, 1.0% or 1.5%.
You're potentially paying 10 to 15 times more in fees every single year for the active management.
15 times. That's enormous. Which leads to the big obvious question. Does it work? Do these active managers actually deliver returns high enough to justify those much higher fees.
The $1 million question. Or maybe the $100,000 question, based on our earlier example. The evidence here is, well, it's pretty clear and consistent over decades.
Yeah, it shows.
Study after study, year after year, shows that the vast majority of actively managed mutual funds fail to consistently outperform their benchmark index after accounting for their higher fees, especially over long periods.
But most of them don't even match the index fund return once you factor in the extra cost.
That's right. Some might have a good year or two, maybe a manager gets lucky or makes a great call, but consistently beating the market year in and year out, enough to overcome that significant fee hurdle, it's incredibly difficult, and most don't achieve it. The index fund, by simply matching the market average at a very low cost, often ends up delivering a better net return to the investor over the long haul.
That seems kind of damning for the active mutual fund model, doesn't it? If the cheaper option usually wins, why are mutual funds still so prevalent? Who should actually consider using them?
It's a really fair challenge. They persist partly due to historical reasons, marketing, financial advisor relationships, and the enduring hope that maybe this manager is the one who can beat the odds. But for the average investor building long-term wealth, the use case is pretty narrow.
What would be a potentially valid reason?
The main argument might be if you want exposure to a very specific niche area of the market where a standard broad index fund doesn't exist or isn't suitable. Maybe it's a very particular type of alternate investment, or small companies in a specific emerging market, or a complex bond strategy.
Something where you really feel you need specialized expertise to navigate that specific terrain.
Potentially. In those cases, you might argue that an expert active manager could add value. But even then, you need to be extremely confident with strong evidence that their potential extra return, their alpha, will be high enough and consistent enough to overcome those hefty fees.
So it requires a huge leap of faith in the manager's specific skill, and you're paying a big premium for that bet.
You are, and if they underperform, you lose twice. You get lower returns and you paid higher fees for the privilege. It's a tough proposition for most people compared to the simplicity and low cost of indexing.
Okay, and just to confirm, the mechanics, do traditional mutual funds also use that same end-of-day NAV pricing we talked about with index funds?
Yes, absolutely. They're typically open-ended funds as well. So you place your buy or sell order during the day, but the transaction happens at the net asset value calculated after the market closes at 4 p.m. Eastern.
Same lack of real-time pricing control.
Same deal. That's a crucial similarity between traditional index funds and traditional mutual funds, and a key difference from stocks and ETFs.
And one last point here, the big fund companies, the Vanguards, Fidelities, JP Morgans of the world, they offer both types, right?
Oh, definitely. This is really important for investors to understand. You can go to Fidelity, for example, and buy a super low-cost S&P 500 index fund. Or you could buy one of their actively managed mutual funds with a much higher expense ratio.
So the brand name doesn't tell you what you're getting.
Not at all. You absolutely have to look at the specific fund's details. Check the expense ratio. Read the prospectus to see if it's passively tracking an index or actively managed. Don't assume anything based on the provider's name. You need to know what strategy you're buying into and what you're paying for it.
All right, let's shift gears dramatically. We've covered the mainstream options, index funds, and mutual funds. Now we're entering a very different world, hedge funds. This sounds exclusive, maybe a bit risky. What's the story here?
Yeah, we're definitely moving away from the typical investment products available to the average person saving for retirement. Hedge funds are a whole different ballgame.
The name hedge suggests they're about reducing risk, maybe. Hedging your bets.
That might have been the original idea decades ago, but the reality today is often quite different. While some do employ hedging strategies, many modern hedge funds are really focused on generating high absolute returns, often by taking on significant risk using complex and aggressive strategies.
Okay, so what is a hedge fund structurally? How is it different from a mutual fund?
The biggest difference is that they are private investment vehicles, typically structured as partnerships. They're not offered to the general public and face much less regulation than mutual funds.
Private. So who gets to invest in them?
They pool money, but only from a select group of investors, usually very wealthy individuals. We'll define that in a second. Family offices, pension funds, university endowments, other large institutions. And because they're private and less regulated,
They have more freedom in what they do.
way more freedom. They can invest in almost anything: stocks, bonds, currencies, commodities, real estate, derivatives, private companies. And more importantly, they can use strategies that are generally off limits or restricted for regular mutual funds.
Okay, let's talk about those strategies. You said aggressive. What kind of things are we talking about? This is where the potential for huge profits, but also huge losses
Mm.
comes in,
Yeah,
right?
absolutely. There are three core tools they use that really amplify both risk and potential reward. First is short selling.
We hear about that. That's betting against a stock, right? Hoping the price goes down.
Exactly. A hedge fund manager might think, say, company XYZ is way overvalued. They'll borrow shares of XYZ, sell them on the open market immediately, hoping the price will fall. If it does, they buy the shares back at the lower price, return them to the lender, and pocket the difference as profit.
But that sounds risky. If you just buy a stock, the most you can lose is what you invested if it goes to zero. What's the risk with shorting?
The risk is theoretically unlimited. If you short a stock and instead of falling, it goes up and up and up. Your losses keep mounting. There's no ceiling on how high a slab price can go, so your potential loss on a short position is infinite. That's a huge risk regular funds typically avoid or heavily restrict.
Okay, unlimited loss potential. Got it. What's the second tool?
Leverage. This is a massive one for hedge funds. Leverage simply means using borrowed money to invest.
So, using debt to make bigger bets.
Precisely. A hedge fund might have, say, $1 billion in actual investor capital, but they might borrow another $2 billion or even more from banks or brokers. Now they have $3 billion to invest.
Why do that?
It magnifies returns. If their $3 billion portfolio goes up 10%, that's a $300 million gain. On their original $1 billion of capital, that's a huge 30% return. Leverage juices the potential upside.
But I sense a but coming.
Oh yeah, leverage cuts both ways, brutally. If that $3 billion portfolio goes down 10%, that's a $300 million loss. Again, on their original $1 billion, that's a devastating 30% loss. A 34% drop would wipe out their entire initial capital. Leverage dramatically amplifies losses too.
And it brings in other risks, like margin calls.
Exactly. If the value of their assets drops too much, the lenders who provided the leverage can issue a margin call, demanding more collateral or repayment immediately. This can force the fund to sell assets at the worst possible time, locking in losses and potentially creating a death spiral.
Okay, short selling, leverage. What's the third aggressive tool?
The extensive use of derivatives. These are complex financial instruments whose value is derived from something else, an underlying asset like a stock index, an interest rate, a currency, or a commodity.
Things like options and futures.
Options, futures, swaps, and even more exotic custom contracts. Mutual funds might use simple derivatives sometimes for hedging, but hedge funds often use them aggressively for speculation. They can make very large bets on market direction, volatility, or tiny price differences, often controlling huge amounts of underlying value with relatively little capital upfront. This adds another layer of complexity and potential risk.
Okay, short selling, massive leverage, complex derivatives. It definitely sounds like a high-risk environment, which explains why you said they're not open to everyone who can invest.
Generally, you need to be what's called an accredited investor. The definition varies slightly by country, but in the US, it typically means you need to have,
A certain amount of money.
yeah, either a net worth of over $1 million, excluding the value of your primary home, or an annual income over $200,000 or $300,000 for a couple for the last 2 years, with the expectation of that continuing.
So you need to be pretty wealthy. Why the restriction? Is it just to be exclusive?
It's primarily about investor protection, believe it or not. Regulators figure that people meeting these thresholds are sophisticated enough to understand the significant risks involved, and more importantly, they have the financial capacity to withstand potentially large losses, even a total loss of their investment without it ruining their lives.
They can afford to lose the money, basically.
That's the underlying idea. Because the strategies are risky, and these funds can and sometimes do blow up spectacularly.
Okay, let's talk cost. We went from maybe 0.1% for index funds to maybe 1% for mutual funds. What does it cost to play in the hedge fund casino?
Hold on to your hat. Hedge funds are famous for their fee structure, often called the 2 and 20 model.
2 and 20. Okay, break that down for us.
The 2 stands for a 2% annual management fee. This is charged on the total assets under management, regardless of how the fund performs. So if a fund manages $1 billion,
They get $20 million a year just for showing up, win or lose.
pretty much, yeah. That covers their operational costs, salaries, research, etc. But then comes the 20.
The 20%.
That's the performance fee, also sometimes called an incentive fee. The fund manager typically gets to keep 20% of any profits the fund generates above a certain baseline or hurdle rate.
20% of the profits.
Yeah.
On top of the 2% management fee.
Correct. So if that $1 billion fund generates a $100 million profit in a year, the managers might take the $20 million management fee plus 20% of the $100 million profit, which is another $20 million, for a total of $40 million in fees off a $100 million game.
Wow. That is incredibly expensive.
It's extremely expensive. This structure means hedge funds need to generate massive returns just to deliver performance that beats a simple, cheap index fund after fees. If an index fund returns 8% and costs 0.1%, the investor gets 7.9%. A hedge fund charging 2 and 20 needs to make, say, 10% just to cover the 2% management fee and deliver that same 8% pre-incentive fee return. Then they need to make significantly more than that to actually outperform the index fund after taking their 20% cut of the profits.
The bar is incredibly high just to justify their existence from a net return perspective.
Incredibly high, which is why they often have to take those big risks using leverage and derivatives. They're chasing returns big enough to overcome the drag of their own fees. It's absolutely not a product designed for or suitable for the average person saving for retirement. It's a specialized tool for sophisticated, wealthy investors seeking potentially high, but highly volatile and risky returns.
Okay, after that detour into the high-octane world of hedge funds, let's come back to products readily available to everyday investors. And this brings us to our fourth type, exchange-traded funds, or ETFs. These feel like a more modern invention.
They are, relatively speaking. And in many ways, ETFs were designed to solve some of the issues or limitations we saw with traditional index funds and mutual funds. They're often described as a hybrid.
Hybrid. How so? What are they blending together?
They take the best parts of index funds specifically, the diversification and typically low costs associated with tracking an index.
Okay, so like an index fund, they usually hold a basket of stocks or bonds designed to mirror a benchmark.
Exactly. Most ETFs, especially the most popular ones, are passively managed and track well-known indices like the S&P 500, just like index funds.
Yeah.
So you get that same broad exposure and diversification benefit.
But they blend that with.
They blend that with the trading characteristics of an individual stock.
So unlike index funds and mutual funds with their once-a-day NAV pricing,
ETFs trade throughout the entire day on major stock exchanges, just like shares of Apple or Google.
okay, that's the key difference. Explain what that means for an investor.
It means you get real-time pricing and liquidity.
Yeah.
If you want to buy or sell an ETF at, say, 10:30 a.m., you can see its current market price fluctuating second by second. You can place your order, and it executes almost instantly at the prevailing market price.
So no waiting until 4 p.m. for the NAV calculation. You know the price you're getting right when you trade.
Precisely. You have that intraday price discovery and the ability to trade whenever the market is open. This gives you much more flexibility and control compared to traditional funds. If you see a market opportunity or want to react to news quickly, you can do that with an ETF.
That sounds like a big advantage, especially for people who like a bit more control or want to react to market movements. How is this possible?
Right.
Why don't ETFs have that same arbitrage issue that open-ended funds worry about?
It's down to their structure. ETFs are typically closed-ended funds, or have a mechanism that functions similarly. They have a special creation and redemption process involving large institutional players called authorized participants, or APs.
Okay, creation and redemption, what does that mean?
Basically, if the ETF's price on the stock exchange starts to drift away from the actual real-time value of the underlying assets it holds, its intraday NAV.
Like if the ETF shares start trading slightly cheaper than the combined value of all the S&P 500 stocks it holds.
Exactly. The APs can step in. They can buy up those cheaper ETF shares on the open market. Then they bundle them up in large blocks and exchange them with the ETF provider for the actual underlying stocks, which are worth slightly more. They profit from that small difference.
And that buying pressure on the ETF shares.
Pushes the ETF's market price back up, keeping it aligned with its underlying value. The opposite happens if the ETF starts trading at a premium. The APs can buy the underlying stocks, exchange them for new ETF shares, and sell those shares on the market, pushing the price back down.
Wow, okay, so this constant arbitrage activity by these big players keeps the ETF's market price tethered very closely to the real-time value of its holdings throughout the day.
That's the mechanism. It allows ETFs to trade like stocks with accurate real-time pricing, solving the NAV problem of traditional funds. It's a pretty ingenious structure, actually.
It really is. Okay, so they trade like stocks, offer real-time pricing. What about the costs? Do they inherit the low fees of index funds?
Generally, yes, because again, most of the popular ETFs are passively managed index trackers. Their expense ratios are typically very low, often almost identical to their traditional index fund counterparts.
So we're talking maybe 0.03%, 0.05%, 0.1% in that same ballpark.
Absolutely. You can find broad market ETFs for incredibly low fees. Now, there are more specialized ETFs or actively managed ETFs, which are becoming more common, and those will have higher expense ratios, maybe up towards 0.5% or 0.75% or even higher. But the core passive index ETFs are very cheap.
Low cost and real-time trading flexibility. That sounds like a powerful combination. Are they easy for regular investors to buy?
Extremely easy. You buy and sell them through any standard brokerage account, just like you would a stock. Most major brokers now offer commission-free trading on ETFs too.
No minimum investment usually either. Can you buy small amounts?
Often you can buy even fractional shares of ETFs, meaning you could invest just $5 or $10 if you wanted to. So they are incredibly accessible to investors at all levels.
Okay, so just to be crystal clear, if I want to invest in, say, the S&P 500, I could choose a traditional S&P 500 index fund.
Right, with the end-of-day NAV pricing.
Or I could choose an S&P 500 ETF.
Correct.
Yep.
Which would give you essentially the same underlying investment exposure, likely a very similar low expense ratio, but with the ability to trade it throughout the day at real-time prices.
So the choice between those two often just boils down to whether you prefer the simplicity of end-of-day pricing or value the flexibility and real-time control of intraday trading.
That's often the main practical difference for passive index investing, yes. Cost and diversification are usually very comparable between the index fund and its equivalent ETF.
All right, we've covered a lot of ground. Index funds, mutual funds, hedge funds, ETFs. Let's bring it all together now. For someone listening, trying to make sense of this for their own investments in 2025, let's do a quick compare and contrast across the key factors.
Okay, let's synthesize. Rapid fire.
Management style, passive versus active.
Passive. Index
Active.
funds and most ETFs. Active. Mutual funds and hedge funds.
Got it. Lowest fees. Where's the cheapest option?
Definitely index funds and passive ETFs. Their automated nature keeps costs rock bottom.
Highest fees.
Hedge funds, easily, with that 2 and 20 structure, followed by actively managed mutual funds.
Risk and volatility potential. Where's the highest chance of big swings, up or down?
Hedge funds again, because of the leverage, shorting, and derivatives. Much higher potential risk profile.
What about liquidity and trading? Which ones can you trade easily throughout the day at known prices?
Only ETFs. They trade on exchanges like stocks, offering that real-time liquidity.
And which ones are stuck with that end-of-day NAV pricing?
Traditional index funds and traditional mutual funds. Their open-ended structure means you only get the closing price. Okay, that quick comparison really lays out the structural differences. Now let's translate that into practical advice. Thinking about that average long-term investor in 2025. How should they approach these options? Maybe think of it like an investment pyramid.
Yeah, I like that. What forms the solid base of the pyramid, the foundation for most people?
The base, without a doubt, should be built with index funds or ETFs. For the vast majority of people investing for long-term goals like retirement or saving for college, these are the simplest, smartest, and lowest cost options.
Why them specifically as the base?
Because they offer instant broad diversification across markets, they're incredibly cheap, which maximizes your long-term compounding, they're easy to understand, and they require very little ongoing effort. You set it up, contribute regularly, and let the market do its thing over time. Low cost, low stress, historically effective. That's your foundation.
Okay, solid base. Index funds or ETFs. What about the next level up? Where do actively managed mutual funds fit?
Mutual funds belong in the middle layer, and I'd say only for specific targeted reasons and only if you've done your homework.
Specific reasons like?
Like maybe you want exposure to a really niche area, as we discussed, perhaps a specific type of sustainable infrastructure project fund, or a frontier market where passive options are limited. Or maybe, just maybe, you found a manager with a long, proven, statistically significant track record of generating alpha returns above the benchmark consistently, even after their higher fees.
But you'd need really compelling evidence for that last one, right? given the data showing most don't succeed long term.
Absolutely. You need to be highly skeptical. You need to look at the net returns after fees over many years through different market cycles. If you were going to pay 5x or 10x the fee, the justification has to be rock solid and data driven, not just based on a good sales pitch or one strong year. So a much smaller allocation, if any, for most people.
Okay, niche exposure or proven alpha, use with caution. And then at the very top of the pyramid, the pointy, risky bit.
That's where hedge funds sit. And this part of the pyramid is really only relevant for a tiny fraction of investors.
The accredited investors we talked about.
Exactly. High net worth individuals and institutions who understand the complex strategies can afford the exorbitant fees and, crucially, have the financial capacity and risk tolerance to potentially lose a significant portion, or even all, of their investment. It's a specialized tool for sophisticated players, not a building block for mainstream financial planning.
So to recap for the listener in 2025, the overwhelming focus for building long-term wealth should probably be on those low-cost, diversified index funds and ETFs. Maybe consider a small slice of active mutual funds for very specific reasons, but be very critical of the fees and performance. And hedge funds, generally just admire them from afar unless you're already in that high net worth category and understand the risks.
That sums it up perfectly. That clarity between the options, the costs, and the risks is absolutely vital. Hashtag tag OTRIP.
Well, this has been incredibly insightful. We've gone from the basic concept of a fund right through to the complexities of hedge fund strategies. Hopefully, we've managed to demystify this alphabet soup of investment options.
The goal was to strip away the jargon and give you that clear operational guide.
And as we wrap up, I want to leave you, our listener, with one final thought. Something to chew on as you think about applying all this.
Yeah, little homework.
We've established that historically, most active fund managers don't consistently beat their passive index benchmarks after fees. We know the fees for active funds are often 5, 10, even 15 times higher. So the provocative question is this. If you are considering paying that huge premium for an active mutual fund manager,
What should you be looking for?
exactly what specific, measurable, quantifiable evidence would truly convince you that their skill is worth that massive cost drag? Is it just they had a good run last year? Or should you demand proof of consistent alpha generation across both bull and bear markets? Maybe evidence of significantly lower volatility, providing smoother returns, or perhaps a documented ability to protect capital better during major downturns.
What concrete metric justifies paying, say, 1% or 1.5% year after year when a passive alternative costs 0.1% or less?
That's the critical question you need to ask yourself before paying for active management. What are you really paying for, and can you prove it's worth the price?
Definitely something to think about. You need to demand that proof, understand that trade-off.
We really hope this deep dive has armed you with the knowledge to understand these different fund types, their costs, their risks, and their trading mechanics.
Use this information wisely. Make informed choices that align with your goals, your timeline, and your tolerance for complexity and cost.
That's all the time we have for this deep dive. Thanks for joining us.
We'll catch you on the next one.